Financial institutions have been hard hit financially, but also in terms of their exposure to litigation. In this interview with Trevor Howard from Liberty International Underwriters, Howard discusses what factors are influencing the directors and officers liability market for financial institutions and what he sees for D&O in 2009.
Well, the majority of publicly traded companies currently purchase D&O policies. What we may see happen is private companies reassess their risk exposure to the credit crisis and look to purchase directors and officers policies for the first time. I do think one of the more important things that may come out of this, however, is a reassessment of limits adequacy. These securities class action claims are becoming increasingly more costly to defend. We're seeing defense costs run upwards in the tens of millions of dollars sometimes, which may erode an entire D&O tower before we even get to the settlement phase. So if I'm a director or officer, I want to make darn sure I have adequate limits in place. I may also look to purchase what's known as a separate Side A tower, which has a dedicated limit that can't be eroded by the entity. Certainly all signs point to the fact that there should be a hardening of the market. From a macro level, you have insurance companies whose capital base has been depleted by losses to hurricanes or just their investment income portfolios being decimated by the credit crisis. On a more micro level, from the directors and officers world, we mentioned before, you have close to 130 securities class action claims filed as a result of the credit crisis. You have the cost to defend those claims and settle those claims continue to increase. Conversely, you have really an excess of capacity in the marketplace still. There's upwards of $2 billion of global D&O capacity available on any given account. The largest programs may utilize 10 to 20% of that. You also have the fact that D&O is a long-tail line of business. So the claims that have come in last year, this year, the reserves aren't going to go up and the checks aren't going to be cut to 2, 3, 5 years from now. So really you're finding, I think the market's moving towards an equilibrium between excess capacity and capital constraints. And I think one of the tipping points might be the reinsurance marketplace. As insurers are unable to access the capital markets or it's cost prohibitive to access the capital markets, they might fall back and utilize reinsurance a bit more. And as that market hardens and firms up, that's going to eventually have an impact on the direct writers as well. Mm-hmm. So it's not going to happen overnight, but that certainly seems to be the avenue we're moving towards right now.